to have Daniel Kemp, now of Portfolio Thinking. He is a investment research firm now, and he's ventured out on his own, formerly of Morningstar Investments. Dan, it's always great to have you, and it's great to have you in the new version of Dan. Thank you so much for joining us again.
Lou, it is great to be with you. Thanks for inviting me on. Yes, it's exciting times.
It is exciting times, and we're going to jump to it because we've got plenty to talk about. And as always, we want to keep this to about 20 minutes where everyone listening or watching. And certainly if anyone has additional questions, please email me, use the calendar link to book some time. Glad to answer them. Dan and I are still in close communication and really enjoying that as he starts this new venture and this new chapter in his work. So Dan, we talked a little bit with our previous money manager, and Caleb now, and we talked about artificial intelligence and where that's at in its, let's say, in its growth or its own birth, and the wave that came about. We're starting to see that large wave of AI break up. What does that mean to the stock market? What does that mean to technology in general, in your opinion? And as investors, what are we looking at for the technology field, which is under great pressure right now? In your opinion, what does it mean for technology stocks with the AI wave crashing, we'll say?
Yeah, sure, Lou. That's a great place to start because we're seeing news about AI and developments of AI and the investment implications of that all around us all of the time. And you're absolutely right that over the last couple of years, so much of investment has been focused on what AI is going to do next, and that wave has lifted all boats. We've seen a lot of the very large technology stocks that we're familiar with and we use the products of sort of every day do very well over that period. And at the same time, we've seen many of these companies invest an extraordinary amount of money and promise to invest even more money in the build out of AI. And in many cases, the business models are not very obvious. How will AI make money? Most people that use ChatGPT don't pay for it. That is a tough business model if you're spending a lot of money. So we've had this great wave of positivity, which markets have benefited from, we will benefit from as investors. But as you say, that wave is now breaking up, that as AI companies are spending large amounts of money, people are being a little bit more careful in how they think about those business models, a bit more differentiating in terms of which companies will do well and which will do poorly. And we've seen over the last couple of weeks that software companies, so companies that build the software that we use all day, but particularly software for businesses, those companies have really suffered. And one of the reasons they've suffered is because AI has started to learn or is able to build software. And so as people have discovered this, that AI can do this, then people are questioning the business models. And so we're seeing a lot of negative stories coming out of the AI narrative, as well as that bigger long-term positive. Now, what that means for technology companies is that they're in for a rougher ride. As investors become more differentiating in their views, then we won't just see all technology companies go up together or possibly kind of go down together. It will break up, as you say. So from the perspective of an investor, this is actually a really good thing because as we see these more negative stories appear, there's more opportunities to buy great companies at cheaper valuations when people are feeling really negative, and that creates long-term higher returns. So that big wave has probably come to an end or is coming to an end. Now it's breaking up. Now it's creating opportunities around the market that weren't there before.
Okay, thank you for that. And we will get, I'll say, back to strong gains and our comfort level, we'll say, with the stock market continuously going up. We'll get to that at the end of this conversation. Would you say, is there some maturity to the AI trade? Now, you and I have been talking about this. So before you answer that question, I went back and I looked at it. We started talking about artificial intelligence right from the beginning of our conversations for clients. So it has been years now that we've been talking about it. And I think we've been very consistent. You have been and I have been in that AI was always something we had an interest in. Crypto or digital currency is something we never had an interest in, and that we maintain that same focus of those two areas of and I won't call crypto or digital investing, but that's speculation. But AI being part of the technology sector, is it maturing, or is it still in diapers, and we're trying to figure out what's the day it's going to start walking? Where is AI at? Saying this wave is breaking up, using that analogy. Where is it at in its growth or development at this point?
Well, I think my view would be that AI, as we understand it today, is now getting much more mature because we've gone from that stage where it was lots of tiny startup businesses and new apps and new ways of doing things, and now we've seen a few big leaders emerge, and they are spending an enormous amount of money to build out the infrastructure because they want to be the dominant player in AI over the coming years. And again, when you get companies with quite small revenues, certainly small revenues linked to AI, they might have big revenues elsewhere. Microsoft has enormous revenues, but it doesn't have high revenues linked to AI yet. When they start spending large amounts of money, then the danger is that investors become nervous because they don't expect these companies to own own large assets. That's not the type of business model they've bought. And in that scenario, we can see prices come down. And so that's normally that cycle of maturity that we go from exciting new concepts to expectations that these companies will change the world, to overspending on capital, to a decline in the share price as people realize that trees do not grow to the sky. There's a limit on everything.
That's right.
And then we'll have another new wave of technology that'll follow it in a little while. But as we look at it at the moment, it feels much more mature. That doesn't mean that AI is going to stop developing or stop improving. That's going to continue ad infinitum. But in terms of the business models that we've seen in the market so far, that's looking increasingly mature.
Okay, excellent. Thank you. We spent plenty of time on artificial intelligence, but I think it deserves it, we'll say, as it matures and at this moment of conversation because of the fact that we're seeing pressure on technology stocks. So thanks for time on that. We had a discussion before we started recording about the reduction of the number of stocks to purchase as, let's call it, a sales pitch by the private equity or private stock companies or private debt companies to invest in. And it's something that I resist because, as I've said to you and I've said to others, it's hard enough to do this work and be as accurate as possible with what we do know, but then add in the element of what we don't know, and I do have to just define it. Private equity means a firm has purchased companies, values, stocks, whatever, but privately, and then they offer that for sale to the public to invest in. But private is just that. It's private. We may not know what it is they own, and we don't know who's valuing it. So your commentary on the reduction of the number of stocks to invest in for day-to-day investors and the impact of or an explanation, if you will, of what private equity, private debt means to the day-to-day investor that may be now buying it in their 401k plan without actually realizing what it is.
Yeah, absolutely. And this is an article that I've been sort of mulling over for a while to put on
Okay.
the new portfolio thinking Substack, because I think we've got used to this idea of the last few years that public markets are bad and private markets are good because prices in public markets are volatile, they go up and down, but prices in private markets only seem to go up. Well, this is obviously
Can't help but laugh. I'm sorry.
yeah,
Yes,
exactly.
sir.
Exactly. It's just madness. And of course, the reason that the stock markets emerged in the first place under the buttonwood tree on Wall Street was because people wanted liquidity. They wanted to be able to exchange the shares in companies they had for stock in other companies or for cash to move money in and out of their investments. And so public markets are superior to private markets in that they allow you to change your mind. They're also superior in the sense that transaction costs are lower and it's easier. There's the information is fairer. Obviously, we went through a period where information was not fair in public markets. Fortunately, we're past that now. So there were very strict rules around information in public markets. So you have this situation where we can access the best companies in the world with perfectly transparent financial statements. We can know what's going on and we can change our mind. And the price we pay for that is that the prices go up and down every day. Whereas in private markets, it's very different because the prices are stable unless they are revalued. And of course, there's a great incentive for the revaluations only to go upwards rather than downwards. But we know that, again, if prices don't reflect reality, then that price is meaningless. And at some point, a private equity investor wants to get their money out of that private company to invest it somewhere else. And so although it is absolutely right to say that the number of public companies around the world, and particularly in developed markets, this includes the US, have fallen since the heyday, I think, back in the 90s and early 2000s. And private equity has filled a really important gap in funding new and smaller companies, particularly when there wasn't an appetite for investment among investors in public markets. That doesn't change the fact that there's an enormous amount of capital in private equity now. So it's not as if you're discovering this secret niche in the market that no one else has found. It's a huge industry. There's a huge amount of money that's gone into it, but not a lot of money's coming out. And that's why there's such a sales job to try and get people to invest more money in private equity funds, because a lot of the traditional investors in private markets, they tend to be the big institutions, the big endowments, the very wealthiest in society. They have had their money stuck in private equity funds because private equity hasn't been able to sell their holdings into the public markets or onto other investors. And what that tells you really is that the price is probably not right. It tells you that there's not that appetite for these apparently unique companies that no one else can access, that actually they're finding difficulty getting the prices that they've set for these companies. So that tells you that actually there's, although the grass may appear greener on the other side of the fence, it probably isn't. That actually there's the fact that these companies are locked up in funds and fund managers are unable to get rid of them, unable to sell them into the public markets. That should be a real warning sign for investors.
Agreed. A red flag. It's a red flag to this financial advisor. And certainly there's money to be made. There's opportunity there. Unpacking what you just commented on a little bit, where let me give a famous person, not that we're not endorsing this person in any way, shape, or form, but Ashton Kutcher, the actor, who has become a private he's got a hedge fund, a private equity fund that he funds smaller companies or growing companies. It's a great example of the out front that this industry has become, and there's money to be made, and certainly like an Uber benefited from having private equity as helping it develop and get to where it is. However, let's say arbitrary number 1,000 not Ubers for an Uber, and somehow those companies are being valued inside private equity, and that valuation is being done by whom? Yeah, and that's an open-ended question. We don't know who is valuing it. So how do you invest or plan around that kind of thing?
Exactly right. It's certainly not being valued by the market. It's not there for all of us to have a view, and so that actually is a weakness. That's not a strength, and it does mean that your portfolio is not so volatile. But we know that volatility is just a normal part of markets. But you raise a really good point there, that when you're investing in private assets, who you're investing with is much more important than in public markets, because investors can change their minds, because we all have the same pool of investments to choose from in public markets. It means that the returns of different portfolio managers over the long term are going to be somewhat similar if they're trying to do the same thing in the same markets. That's not true in private markets. The differentiation between the best managers and the worst managers is enormous. And of course, it's much more difficult in private markets to access the best managers. And that means that quite often investors like you and I going to private equity investments for the first time are not going to have that access, and we're going to have lower returns, substantially lower returns than the best investors are producing. So even if private equity is the right part of your portfolio, and it might be for some people, just be very, very careful about which managers you're investing with, because that will make a much bigger difference than you expect.
Excellent advice, and thank you for that. So I think at some point, Dan, we'll have to have a conversation about maybe the future of the stock market, the public stock market. That could be a lot of fun for everyone to hear inside the mind of Dan Kemp and Lou Tranquilli as to what the future looks like. That would be, we don't predict, we prepare, but that would be a prediction conversation, and we might just have to have that. So thinking about it, the conversation on AI, the private equity, and volatility in the market as it stands right now, should we be looking at larger company stocks? Should we be thinking more about dividend? A year or so ago, we were really talking foreign equity or let's say non-US based equity, okay, rather than using foreign equity, let's say non-US based, looking outside. We're still looking outside to some degree, but dividend stocks and more traditional firm names that we know. And I won't bring up a bunch of names. I'll just say the names that we go to the grocery store, or we look for a new vehicle and we're going to buy. Should we be looking in that direction, or is there some other balance that maybe you think right now is appropriate?
Yes, I think that's absolutely right. That large companies in traditional industries, either inside the US or outside the US, certainly look more attractive. And typically, of course, we'd have accessed those companies by buying an index tracker. But now the index trackers are dominated by those huge technology businesses. Actually, you're not getting that level of diversification. And that's where, let's say, your philosophy at Tranquilli Financial Advisors of mixing different asset managers, making sure that there's different philosophies of money, making sure there's diversification of the portfolio is so important at the moment, because that small number of stocks are so concentrated, or the market's so concentrated with a small number of stocks. So diversification is key. Large companies that offer attractive dividends provide a great stable return in portfolios, because the need to provide that dividend can often help managers of these businesses make good decisions if they know they can provide dividend checks. So that can be really beneficial. We're still seeing opportunities in smaller companies. Again, not the small, very fast-growing tech stocks. Some of those look expensive despite the declines in software recently. But smaller stocks in more traditional industries, again, they look attractive. So there's plenty of opportunities for investment, but what we know is, going back to the AI point, is that if investors turn more fully against technology stocks, if they become overly concerned about what's happening in technologies, as they did 25 years ago, then we may see the index declining because of the dominance of technology stocks, but there may still be companies within that that are doing very well. That's exactly what we saw 25 years ago, and that's what we expect to happen again as people don't sell out entirely, but they go hunting for high quality, lower valued companies than chasing these large tech stocks.
Excellent. Well, and the point being that if we're looking towards dividend stocks now, and maybe now isn't the at their highest value, that's not when we would want to buy them, but the market joins us in wanting to own those. Well, if we're already holding on to them, our value goes up, of course. And sorry for the stock market 101 lesson, but I just think sometimes it's great to just point it out. That's what we're getting at, is maybe we're a little ahead on the dividend stock trade, but that's okay. Be a little bit ahead of it because we can sit and wait. We're patient that way. To wrap it up, we've all become used to, and I'll say this financial advisor included, seeing the mountain chart, okay, for part of the visual, but going upward, and it's awfully nice when we see that, and we all like it. And I'm not looking to say bring it down, but we've become used to it, to seeing those gains. If you were going to say how we should shift our thinking, maybe, because this is a little bit, well, even a lot of it, unrealistic, what's gone on the last 18, 24 months, because I would remind everyone that we had about an 18-month period from 2021 to 2023 where there was a lot of not fun in there, let's say. It was grueling. So what is the preparation that you as an investment consultant, what are you preparing clients for right now?
Yeah, of course, Lou. And I think that the way that I've often described in the past is that for every 10 years that somebody talks to me about investing, for at least 2 years, I'll look like a complete idiot, because that's the point when I'm saying investing is great, investing is long-term, and markets are declining. And so we do have these periods when we go from people feeling fantastic about investing, more money pouring in, prices going up, everyone feeling good about their portfolio, and they're inevitably followed by periods where prices are going down. And again, to take a sort of farming analogy, we can think about this as the normal cycle of the farming year, that there are points where you are harvesting the gains of the last season, and other periods where you are planting the seeds of the next season. And so as prices are high, that tends to be when you do your harvesting, when you start looking for those unloved stocks, maybe the dividend stocks you talked about, maybe the overseas stocks that we were talking about last year. That's when you start harvesting those gains that we've seen in high-priced US stocks. And then when everyone else is panicking about the market falling, that's when you sow the seeds of the next harvest by buying these stocks that are unloved. They may be in technology, they may be elsewhere, but as long as you are recycling that capital, recycling that seed into the fertile ground for the next season, then you'll be fine over the long term. That doesn't mean it's not difficult. Doesn't mean it's not painful. Doesn't mean that we all look at our portfolio sometimes think, oh crumbs, it was so much more than that 6 months ago. That's part of being human. But investing is always about looking forward and doing that harvesting when it's appropriate, doing the planting when it's appropriate, and trying to stay away from all of that market news when people are screaming about prices going down.
Love that analogy. Yep, I have nothing to add. Let's be farmers, okay? I'm good with it as it applies to stocks. Dan, really appreciate it. Portfolio thinking, and to give everyone, it's portfolio-thinking. Your investment research. Can people that are listening sign up for your Substack if they'd like to?
They absolutely can. I'd love it if that was of use. So the portfolio thinking Substack, if you're familiar with Substack, then go on there and look for portfolio thinking. And what I've been doing over the last few weeks, as you know, Lou, is just building up the foundations of how we think about investing. And then we're just starting now to talk about particular markets, particular assets, to try and give people the mental toolkit so that when they're coming to you for advice, they have that background. But of course, anything that you'll find that I write or that's on portfolio thinking or anything else that we do, that's very generic. It's not tailored to the individual. Of course, the great power, as I always tell people, is within that financial advice relationship. That's where you're going to get that personalized information, that personalized portfolio that's going to help you reach your goals. So this should never be seen as a substitute for that. All the hard work happens through you, Lou, and through you with your clients. I just get to write about it.
We'll make it specific, and you'll help us do so, Dan. So well done as always. Thank you so much, Daniel Kemp, Portfolio Thinking. We'll do it again this year.
Absolutely.
All right, good. I think we owe everyone a conversation about what we think the future of the stock market could be. So, all right, thanks again, everyone, for watching, listening. And of course, if you have any questions, please reach out to me, and I'm glad to have a conversation.